The break-even chart is not wrong. It's worse than wrong. It's technically accurate and completely useless at the same time, which is somehow harder to argue against. Here's what I mean. The standard advice says claim Social Security at 62, and if you live past 78, you would have been better off waiting. That's the whole thing. That's the chart. And what it leaves out is your spouse's check after you die. The tax bracket you'll be shoved into at 73 when the government forces you to withdraw money whether you want to or not. And the fact that the people who get hurt worst in this decision aren't the ones who die at 74, it's the ones who live to 88 on a permanently smaller paycheck. So today, I'm going to show you a Social Security strategy that accounts for all of that. And by the end of this video, you'll understand why the claiming decision is actually a tax strategy dressed up as a retirement question. That's the real frame. Not when do I break even, but which sequence of decisions protects me and whoever I love if everything goes wrong at once. Let's get into it. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They use oversimplified break-even logic and completely ignore tax sequencing. Mine uses BlackRock and Vanguard methodology to expose the actual weak points in your retirement plan. I only ask for your email to send the report because I don't store any of your financial data. Link is in the description. Now, the central metaphor I'm going to use throughout this video is a pressure cooker. Think about your pre-tax accounts, your 401k, your traditional IRA as a pressure cooker sitting on the stove. Every year you don't touch it, pressure builds inside. At age 73, the government turns the heat to maximum and says you're withdrawing money whether you plan to or not. Those are required minimum distributions. The RMDs, and if you've been a disciplined saver for 30 years and that pot has grown to $1.2 million or $2 million, those forced withdrawals can push you into a higher tax bracket than when you were working. The pressure cooker explodes and the IRS is right there with a bowl. Social Security is the pressure valve. It's a separate release mechanism that you control the timing of. And the mistake almost everyone makes is releasing the valve too early, before they've had any chance to carefully vent the pressure cooker. You claim at 62, Social Security fills up your lower tax brackets every single month from that point forward. And now, when the pot eventually explodes at 73, every forced withdrawal stacks on top of those Social Security dollars. Every Roth conversion you wanted to do is now expensive. Your options compress. Your flexibility disappears. That's the pressure cooker problem. And I'm going to come back to it every time we move to a new piece of this puzzle. In a few minutes, I'm going to walk you through a specific scenario. A guy named Marcus, 58 years old, $2.1 million in pre-tax accounts, retired early. And I'm going to show you exactly how the sequence of his decisions will either cost him or save him several $100,000 in taxes over a 20-year retirement. But first, let me show you why the tool everyone uses to make this decision is built on an assumption so flawed it's almost funny. There's this concept in decision science called the map territory error. It's when people confuse the model for the reality. The map says the road is straight. The territory has a cliff. You follow the map right off the cliff. The Social Security break-even chart is a map with a cliff on it. Here's how the chart works. You go to any retirement website, Social Security's own website will do this for you. You plug in your birth year and your earnings history, and it calculates two scenarios. Scenario 1, claim at 62, smaller monthly check, but you get it for more years. Scenario 2, claim at 67 or 70, bigger monthly check, fewer years to collect. The calculator finds the crossover age. That's your break even, around 78 for most people. If you die before 78, early wins. Die after 78, delay wins. Clean, simple, wrong. The problem isn't the arithmetic. The arithmetic is fine. The problem is what the arithmetic doesn't model. It doesn't model your spouse. It doesn't model your tax bracket at 73. And it doesn't model what I'm going to call the asymmetry of regret. Let me take each of those in turn, because each one is doing more damage than people realize. When one spouse in a married couple dies, the survivor doesn't keep both Social Security checks. They keep one, the larger one, and the smaller benefit disappears permanently. So if you are the higher earner in your household and you claimed at 62, you locked in a reduced benefit not for your lifetime, but for your spouse's lifetime after you're gone. The person most likely to spend the most years collecting Social Security in your household is your surviving spouse. And the check they'll collect for potentially a decade or more is determined by the decision you made at 62 when you were more focused on break-even math than on your wife's finances in her mid-80s. That's not a math problem. That's a framing problem. Now, the asymmetry of regret. Think about two possible futures. In future 1, you delay claiming to 70 and you die at 75. You lost by a few years of checks. Your spouse still collects the larger survivor benefit. Nobody in your family is scrambling financially. That outcome is suboptimal on a spreadsheet. In future 2, you claimed at 62 because the chart said 2 and you lived to 89. You've been collecting a permanently reduced check for over 2 decades. Inflation has chewed through your purchasing power. Medical costs in your mid-80s were higher than any spreadsheet projected, and your spouse outlives you by 7 years on that smaller check. One version of regret is, I left money on the table. The other version is, I permanently underfunded the longest and most expensive years of our lives. Those are not symmetric. One of those is a minor inconvenience. The other is a catastrophe. And the break-even chart treats them like they weigh the same. Researchers at Boston College's Center for Retirement Research ran an analysis of this specific problem. And the conclusion was consistent. When you account for longevity risk, spousal survival probability, and inflation adjustments, delayed claiming is the dominant strategy for the vast majority of married couples, where the higher earner is in reasonable health, not because they'll definitely live long enough to win on a break-even chart, but because the cost of being wrong about longevity in one direction is manageable, and the cost of being wrong in the other direction is not. The break-even chart optimizes for dying at a convenient age. The accurate strategy optimizes for the case where you don't. Now, here is what nobody is actually telling you. In a married couple, the higher earner's Social Security claiming decision is not really about the higher earner. It's about the surviving spouse. And once you see that clearly, the entire framing of this decision changes permanently. By the way, hit subscribe if you're finding this useful. Otherwise, YouTube's algorithm may genuinely never show you my videos again, and this is a channel worth keeping track of. Back to the widow insurance problem, because this is where the real numbers live. There's a retirement planner I know personally who works exclusively with couples within 10 years of retirement. He tells every new client the same thing on day 1 of their first planning meeting. He says, I need you to tell me who in this room is most likely to still be alive at 90, because that person is going to make the most important decision in this conversation. And the room always gets quiet. Because most couples walk in thinking they're making 2 separate decisions. When does he claim? When does she claim? And they walk out understanding they're actually making one integrated decision that protects whoever survives longest. Here's how the numbers play out in a concrete scenario. Say you and your spouse are both 62. You're the higher earner. Your full retirement age benefit, the amount you'd receive at 67, is $2,800 a month. If you claim at 62, that drops to approximately $2,000 a month due to the early claiming reduction. If you delay to 70, that grows to approximately $3,600 a month. Inflation adjusted, government backed. Guaranteed as much as anything in American financial life is guaranteed. Your spouse's benefit is lower, say $1,400 at their full retirement age. Now you die at 78. Under Social Security survivor rules, your spouse stops receiving their own benefit and receives yours instead, whichever check is higher. If you claimed at 62, they inherit around $2,000 a month. If you had delayed to 70, they inherit around $3,600 a month. That difference is $1,600 every single month. For every month your spouse is alive after you, if your spouse lives to 88, which is not an unusual outcome for women who reach their early 60s today, that's 10 years of $1,600 of monthly difference. That's $192,000. Let that land for a second. Now add the inflation adjustments on that larger base. Add the Roth conversion opportunity we're about to get to. The actual lifetime differential in total household wealth across those scenarios can be well north of $300,000 from one decision. Made at 62, this is why the framing I use is not break-even age. The framing is the higher earner's claiming age is the premium on a longevity insurance policy for your surviving spouse. The premium you pay is the income you forego during the delay years. The policy pays out as a permanently larger check across 2 lifetimes, not one. And here's the kicker about insurance. You cannot buy it retroactively. You can't call up Social Security at 68 and say, actually, I've reconsidered. I'd like the larger survivor benefit now. That decision locked when you filed. The pressure valve, once released, does not go back up. Now I want to introduce Marcus, because Marcus is going to follow us through the rest of this video and show us how all these pieces actually connect in a real financial life. Marcus is 58. He retired early at 56 after selling his minority stake in a regional logistics company. He has $2.1 million in a traditional IRA and about $300,000 in a taxable brokerage account. His wife, Diana, is 54. She has about $400,000 in her own 401k. Marcus's projected full retirement age Social Security benefit is $3,200 a month. Diana's is about $1,800. Marcus found a break-even calculator online. It told him to consider claiming at 62. He sat across from a planner I know and said, look, I don't need the income right now, but the calculator says 62 makes financial sense, and I'm leaning toward it. The planner asked him one question. Marcus, what does your tax picture look like at 74? Marcus had no idea. Nobody had ever asked him that. He'd been thinking about break-even ages. He hadn't been thinking about the silent pressure cooker sitting on his stove, getting hotter every year. We're coming back to Marcus. Because what happens to his tax situation at 73 is precisely what should determine his Social Security strategy, not a chart. Now, here's the part of this that almost no financial content on YouTube covers clearly. And it is, in my opinion, the single most underrated piece of the entire Social Security puzzle. When you retire, before you claim Social Security, whether that gap is 2 years or 12 years, you enter what I call the low income window. Your paycheck is gone. Social Security hasn't started. You're drawing down investments. And on paper, that decade looks like a problem, a dead zone. You're watching your net worth decline. It feels wrong. But here's the reversal. You think the problem is spending down your portfolio in the gap years. The actual problem is what happens if you don't. Because at age 73, required minimum distributions begin. The IRS calculates a percentage of your pre-tax account balance that you must withdraw every year, whether you want that income or not, whether you need it or not. For someone like Marcus, with $2.1 million in a traditional IRA today, assuming a modest 6% annual growth over 15 years, that balance at 73 is somewhere around $5 million. His first RMD alone could be approximately $185,000 in a single year, forced taxable income. Whether he's ready or not, now stack Social Security on top of that. If Marcus claimed at 62, he's been receiving about $2,300 a month, around $27,600 a year. Up to 85% of Social Security benefits are taxable once your combined income crosses the relevant threshold. So Marcus adds roughly $23,000 of taxable Social Security income on top of $185,000 in RMDs. He's now firmly in the 32% federal bracket on money he didn't choose to take, money the government forced him to take. The pressure cooker exploded. Now, here's what Marcus's low-income window from age 56 to 68 can look like if it's designed correctly instead of wasted. During those 12 years, Marcus has almost no taxable income, no W-2, no Social Security, no RMDs. He's drawing living expenses from his taxable brokerage account, mostly long-term capital gains, taxed at 15% federal. For the additional income he needs, he can pull from his traditional IRA and pay 22% federal tax. Or better, he can do deliberate Roth conversions, paying 22% on money he chooses to convert, permanently relocating it out of the future RMD calculation and into a Roth account that grows tax-free forever with no required distributions ever. Every dollar he converts in that window is a dollar that will not be in the RMD calculation at 73. Every conversion is a dollar growing tax-free. And critically, every additional year he delays Social Security is another year that low tax window stays open. Because the moment those Social Security checks start, they begin occupying his lowest tax brackets every month. The space for cheap Roth conversions shrinks. The pressure valve has been released, and the window for venting the pressure cooker has narrowed. This is the core insight that most people miss. Social Security sequencing and tax sequencing are the same decision. Let me put specific numbers on this, because vague tax claims are useless. If Marcus converts $150,000 per year for 10 years, from age 58 to 67, paying roughly 22% federal tax on that amount, he pays approximately $33,000 per year in additional federal tax. Over 10 years, that's $330,000 total. Sounds painful. But those conversions reduce his traditional IRA by $1.5 million of principal, and they prevent that money from continuing to compound inside a pre-tax account. The result at 73 could be a traditional IRA worth approximately $2.2 million instead of $5 million. His first RMD drops from around $185,000 to approximately $82,000. His effective federal tax bracket at 73 drops from 32% or higher to potentially 24%. And all the money he converted is sitting in a Roth, growing tax-free with no future forced distributions ever. Lifetime federal tax savings modeled over a 25-year retirement, often several $100,000 more than the $330,000 he paid in conversion taxes, often by a significant margin. And Social Security sequencing made all of that possible. By holding the pressure valve until 70, Marcus kept the conversion window open long enough to actually use it. The two systems worked together. The pressure cooker got vented carefully. The valve was released at maximum pressure. I watched Marcus's expression in that planning meeting when this was laid out for him. He'd walked in with a break-even chart. He walked out understanding he had a $5 million pressure cooker on his stove that nobody had mentioned to him in 2 years of post-retirement life. There's always someone in the comments who says, "I'd rather enjoy my money now while I'm young and healthy." And I genuinely respect that instinct. I do. I want you to enjoy your 60s. I want everyone to enjoy their 60s. I just want to point out that while I'm young and healthy, and at age 62 is an extremely optimistic way to describe early retirement. Sir, you have a standing appointment with your cardiologist and your left knee has opinions about the weather. You are not exactly in the prime of youth. But yes, spend the money. We'll get to which pocket it should come from. Here's where it gets really interesting. Because the pushback I hear most often about delaying Social Security sounds smart on the surface. It goes like this. Sure, my benefit grows 8% for every year I delay past full retirement age. But I could take the money at 62, invest it in an index fund, and beat the government's math on my own. 8% is 8%, right? Wrong. And the comparison is completely broken for 3 specific reasons. First, the delayed retirement credit isn't a market return, it's a permanent structural increase in your monthly benefit. An increase that then compounds through cost of living adjustments every year for the rest of your life. Those COLAs are applied to a larger base if you delayed. At 2.5% average annual inflation, the gap in absolute dollar terms between the larger and smaller check widens every single year. You're not just comparing checks today. You're comparing trajectories over potentially decades. Second, you're comparing a volatile market investment to a government-guaranteed, inflation-adjusted income stream with zero default risk. Those are categorically different instruments. Comparing an 8% nominal equity return to a structural benefit increase that comes with federal backing and inflation indexing is like comparing a junk bond yield to a treasury yield and concluding the junk bond is obviously superior because the number is higher. One of those has a risk premium baked in, the other doesn't. Third, the peer-reviewed research, and I mean the actuarial and economic literature, not a YouTube calculator, consistently finds that for people who live into their late 80s and 90s, delayed claiming produces the economic equivalent of a 4 to 6% real inflation-adjusted return. Real means after inflation, not nominal, not before fees, after inflation, guaranteed from the federal government. Show me a 4 to 6% real guaranteed return anywhere in 2026. I'll genuinely wait. There's an old story about a fisherman and a banker. A banker goes on vacation to a coastal village and meets a fisherman who works 2 hours a day, earns enough to feed his family, and spends the rest of his time with his kids and his wife and out on the water. The banker says, if you worked 8 hours a day, in 10 years, you could buy 2 boats. In 20 years, you could own a fleet, hire other fishermen, maybe sell the operation for a lot of money. The fisherman asks, and then what? The banker says, then you could relax, spend time with your family, fish whenever you want. The fisherman just nods quietly. And what exactly do you think I'm doing right now? The point of that story isn't that planning doesn't matter. It's that the frame matters. When you ask, should I delay Social Security or invest the money myself, you're asking the banker question. You're assuming the goal is to maximize the number at the end. But the fisherman already has the thing you're optimizing toward: security, predictability, inflation protection, guaranteed income for life. You have access to that thing. The question is whether you're willing to hold the pressure valve until it's at maximum. There's also a second dimension to the investment argument that almost nobody talks about in plain terms. It's called sequence of returns risk, and it is one of the most quietly destructive forces in early retirement. Here's the scenario. You retire at 62. Markets are flat or negative for the first 5 or 6 years of your retirement. You're pulling from your portfolio for living expenses throughout that stretch. You're also receiving a smaller Social Security check because you claimed early. Because you're selling portfolio assets in a down market to fund spending, you're locking in losses. Those shares are gone. They recover for whoever buys them from you, not for you. Your portfolio doesn't fully participate in the eventual recovery. This is the sequence of returns problem. It doesn't require a catastrophic crash. It only requires mediocre market performance in the early years of retirement, which is historically common and mathematically guaranteed to happen eventually. Delayed Social Security changes this equation in a specific way. If you delay to 70 and fund early retirement from your portfolio, you accept more drawdown in the short term, but you're building a larger permanent income floor. When markets recover, your portfolio has more time to do so before you depend on it as your primary income source. The larger the guaranteed income floor, the less you need to sell assets in a bad sequence. The larger the floor, the more your remaining portfolio can be positioned for growth rather than defensive income generation. The pressure valve and the pressure cooker are working together again. The valve held at maximum pressure until 70 protects the cooker from blowing apart in a bad sequence of early returns. The cooker funds the gap years while the valve builds. They're not separate decisions. They're one system. Let me give you a realistic case study. Not Marcus. He's a high balance situation. Someone closer to a typical viewer of this channel. Call him Robert, 54 years old, project manager at a construction firm for 26 years. He has $380,000 in a traditional 401k. He has $42,000 in a Roth 401k. He owns his home free and clear. His wife Sandra is 51. She works part-time and has a small IRA worth $68,000. Robert's projected full retirement age Social Security benefit at 67 is $2,140 a month. Sandra's is $960. Robert has been planning to retire at 62 and claim Social Security at the same time. He's done the break-even math. He needs roughly $4,000 a month in retirement between the two of them. He figures Social Security plus 401k withdrawals covers it. Here's what the break-even calculator never showed Robert. If he retires and claims at 62, he receives about $1,530 a month from Social Security. That's the 62 reduction applied to his full retirement age benefit. His 401k needs to cover the remaining $2,470 every month. That's around $29,600 a year of portfolio withdrawals starting immediately. After 5 years, Sandra retires. Now they need the full $4,000 monthly. Between their two Social Security checks, they're covering roughly $2,900. The 401k covers the rest. Robert's 401k, drawing down at that rate with modest market growth over 11 years, might sit around $280,000 by the time he's 73. His first RMD at 73 is approximately $11,200, roughly $933 a month. Manageable. Robert's situation isn't Marcus's situation. The pressure cooker here isn't enormous. Robert doesn't have a catastrophic tax bomb waiting, but Robert has a survivor problem hiding in plain sight. Sandra is 51 today. Women who reach 65 in the United States have a median life expectancy of approximately 87 years. If Robert dies at 79, near the current median life expectancy for American men, Sandra has 8 or more years ahead of her, possibly significantly more. She'll need income for every one of those years. Under Robert's plan, she inherits $1,530 a month. Robert's early claim permanently reduced benefit. Under a strategy where Robert delays to 67, she would have inherited $2,140 a month. Under a delay to 70, closer to $3,080. That's a difference between the 62 and 70 scenarios of $1,550 every single month, over 8 years. That's $148,800. Sandra's ability to pay property taxes, handle medical expenses, maintain her quality of life, it all flows from a decision Robert made at 62, looking at a chart that never mentioned her name. Robert isn't a wealthy man. He's a diligent middle-class guy who did mostly everything right. The gap between his outcomes isn't exotic tax strategy. It's sequencing. It's knowing which question to ask first. Now let's close the loop on Marcus. Because Marcus made a decision. After 4 planning sessions, he committed to a conversion strategy. $120,000 per year in Roth conversions for 9 years, from age 58 to 67. He'll draw living expenses from his taxable brokerage account first, mostly long-term capital gains at 15% federal. The Roth conversions come on top of that, taxed at 22% on most of the converted amount. At 67, his taxable brokerage will be substantially drawn down, but his traditional IRA will be meaningfully smaller than if he'd done nothing. His Roth will be substantially funded. At 70, Marcus claims Social Security. His benefit, delayed to maximum, is approximately $4,590 a month in today's dollars, inflation adjusted upward. From there, Deanna claims her own smaller benefit at 65. His RMDs at 73 will be calculated on a traditional IRA roughly 40% smaller than if he'd never converted. His first forced withdrawal is manageable. His combined income at 73 is significant, but not catastrophic. His lifetime federal tax burden, modeled over a 25-year retirement, is projected to be roughly $400,000 lower than the claim early, convert nothing baseline scenario. $400,000. Not from a clever investment thesis, not from a hot tip, from understanding how 2 existing government systems, Social Security and the tax code, interact with each other, and sequencing them correctly. Marcus isn't a genius. He asked the right question at 58. That's the whole thing. Now let me give you the framework that pulls all of this together, because frameworks are how the important stuff actually sticks. I call it the 4 questions. And this is what an accurate Social Security strategy actually looks like when you sit down to make the decision. Question 1 is, who survives? In a couple, you start with the surviving spouse scenario before you start with any break-even calculation. What claiming age for the higher earner leaves the survivor with the most stable, largest, most inflation-protected income floor? That person, the one most likely to be alive at 90, is driving the higher earner's strategy. Work backward from their situation, not forward from a crossover chart. Question 2 is, what does my tax picture look like at 73? Pull out your retirement account balances today. Project them forward at 6% annual growth to age 73. Look at the IRS uniform lifetime table to estimate your first RMD. What tax bracket does that forced withdrawal put you in? If the answer makes you uncomfortable, you have a pressure cooker problem. The follow-up question is how much low-income window you have before Social Security starts, and how much of that window you can use for controlled Roth conversions at rates you choose. Question 3 is, am I comparing the right things? When someone tells you to take Social Security early and invest it yourself, ask whether they're accounting for sequence of returns risk. When you hear 8% growth, ask whether you're comparing a market return with full volatility to a government-backed inflation-adjusted annuity with no default risk. When your brain says, I want to enjoy my money while I'm young, ask which pocket funds, which decade, and whether future you at 84 gets a vote in that decision. Question 4 is, what is my actual case for claiming early? There are legitimate ones. Health that genuinely and significantly reduces expected longevity, agreed upon by your doctor. Very small pre-tax balances, where the tax window argument doesn't apply because there's no real RMD bomb to defuse. True financial necessity, not preference. Necessity, meaning real instability without that income. Or being the lower earner in a couple where the higher earner is already committed to delaying. If none of those are true, if you're in reasonable health, you have meaningful pre-tax savings, and your portfolio can bridge the gap years, then delayed claiming is not a gamble. It's insurance against longevity, against bad market sequences, against rising costs in your 80s. Those are the 3 things that actually end retirements. Not the wrong break-even calculation. There are 2 piles and 2 timelines nested inside those 4 questions. 2 piles, pre-tax money and after-tax, or Roth money. 2 timelines. The years before Social Security starts and the years after. The strategy is to use the first timeline to strategically shrink the first pile through controlled conversions, so that the second timeline is protected by a larger income floor and a smaller forced distribution. That's the whole system. Not complicated, not secret, not taught in the break-even calculator. Let your portfolio buy you freedom in your 60s. Let Social Security buy you security in your 80s. Those aren't competing goals. They're the same plan, sequenced correctly. And look, the system works exactly as it was designed to work. It rewards the people who understand the actual structure of the rules, not the people who followed the chart, not the people who listened to a brother-in-law's hot take at Thanksgiving. The people who asked, what does the tax code actually do to my retirement accounts at 73, and which decision I make today changes that outcome the most? Lazy investing built more fortune than crypto memes. That's not a line about being passive. It's a line about understanding how systems actually work and positioning yourself inside them intelligently while everyone else is chasing price charts and trying to time the market. The people who got rich in crypto were mostly lucky and mostly gave it back. The people who systematically aligned their tax sequencing with their Social Security strategy and let 30 years of Roth compounding do its quiet work, those people are boringly, irrevocably, permanently wealthy. Nobody made a video about it because it doesn't have a price chart. It doesn't go up 400% in a week. It goes up the way water fills a glass. The break-even chart is still sitting on 1 million financial planning websites, doing 1 million people a disservice. It'll still be there tomorrow. The system is still working exactly as designed. Amuse yourself with that.